Welcome to ValueVest Daily. So, Bitcoin just ripped through a massive price ceiling. And you might be thinking, here we go again, another crypto pump. But I'm telling you, this time feels different. Today we're going deep, right into the engine room of the global economy, to show you the powerful, kind of hidden forces that are really driving this breakout. It's this wild story connecting artificial intelligence, a financial setup that should honestly make savers nervous, and a huge political shift. Let's start connecting the dots.
Okay, real quick before we dive in, here's our standard disclaimer. Just a reminder, this isn't financial or tax advice. Everything we're talking about today is for educational and informational purposes, period. Our job is to help you connect the dots so you can think more critically. Always do your own research before making any kind of investment decision.
All right, let's get right into the thick of it. The big question, why did Bitcoin all of a sudden just blast past $76,000? This wasn't just some random market blip. No, this move felt significant, and it might be signaling that something much bigger is churning just beneath the surface.
And just look at that number. We're not just talking about getting back to an old high here. We are knocking on the door of $80,000. This move, it's got conviction, it has huge volume behind it, and it's happening while the rest of the market is also feeling pretty strong. You can feel it. A powerful news story is starting to take hold, one that goes way beyond just simple crypto speculation.
And that is exactly what this explainer is all about. We are going to connect three enormous, seemingly unrelated dots for you. The first, the trillion-dollar build-out of artificial intelligence. The second is the return of a financial condition that absolutely punishes savers. And the third is a growing political movement that has the ultra-wealthy scrambling for a place to park their capital. You put them together, it's the perfect storm.
So here's our game plan for today. We'll kick things off with the breakout itself. Then, we'll connect our three big dots: the AI impact, those negative real rates, and the threat of wealth taxes. From there, we'll pull it all together into this new safe haven idea. And finally, we'll talk about what all this might mean for your portfolio.
Okay, let's get into section 1, the breakout. What actually happened on the charts? And more importantly, what's the real story that most of the mainstream coverage might be missing?
So here's the play-by-play. For weeks, right, Bitcoin was just stuck. Kind of boring, trading sideways between $60,000 and $75,000. And then, bam, a breakout with some serious muscle behind it. Now, the immediate spark? Sure, you had some good geopolitical news that calmed the markets, plus all that big money that just keeps pouring into the new Bitcoin ETFs, and the market is clearly in a risk-on mood. But here's the crucial part, and the whole point of our deep dive today. Those are just the sparks. The real fuel for this fire is a massive macroeconomic undercurrent that we're about to explore.
And that brings us to our very first dot. Now, this is the piece of the puzzle that almost everyone is overlooking. The absolutely colossal, world-changing amount of money being spent right now on artificial intelligence.
Just try to wrap your head around this number. We are talking about over $650 billion. And get this, that's just the estimated spending for 2026 by only 4 companies. This isn't just a tech investment, it is one of the biggest infrastructure projects in human history, and it has very real, very physical consequences for our economy. And this lays out the chain reaction perfectly. So first, you've got this insane build-out of AI data centers. These are not your old server closets. We're talking about power-hungry monsters. That leads directly to step 2, a skyrocketing demand for electricity. I mean, we're going to need whole new power plants just to run these things. And what happens when demand for anything skyrockets? The price goes up. That's step 3. And all of that flows directly into the final step, a structural, long-term boost to core inflation. This isn't a temporary blip. It's a new, sticky kind of inflation that the Fed can't just easily fix by raising rates.
You know, that inflation piece leads us right to our second, and honestly maybe the most critical thought of all, the very real threat of negative real interest rates. This is a concept that every single person with a savings account needs to understand.
Let's just look at the numbers. Core inflation has been super stubborn, right? It's hovering way above the Fed's target. At the same time, the Fed's interest rate is only a tiny bit higher. I mean, you can see it right there. That margin is razor thin. We are dangerously close to a world where the real return on your savings is 0, or even worse, negative.
So what in the world is a real interest rate? It's actually pretty simple. You take the interest rate the bank gives you, that's the nominal rate, and you subtract the rate of inflation. That final number is what really matters because it tells you if your money's ability to buy things is actually growing or if it's shrinking. It's the true return on your cash.
And this comparison just makes it crystal clear why this is a huge deal. In a world with positive real rates, savers win. You know, how it's supposed to work. Your cash in the bank, your bonds, they actually earn you money, and your purchasing power grows. But in a world of negative real rates, the script gets flipped completely. Savers get crushed. Cash and bonds basically become melting ice cubes. Their value is actively being destroyed by inflation. And in that kind of environment, capital doesn't just sit still. No way. It flees. It desperately searches for a safe harbor. And historically, that has always meant hard assets like gold, real estate, and, well, you can see where this is going. Scarce digital assets like Bitcoin.
All right, now let's add our third and final dot to this already complicated picture. So while your savings are potentially being eaten away by inflation, there's another force at play, a growing political push for taxes that specifically target wealth itself.
And listen, this isn't just chatter anymore. There is real political momentum behind these kinds of proposals. At the federal level, you're hearing about things like an ultra-millionaire tax. At the state level, you see proposals for new billionaire taxes. And maybe the most concerning for wealthy people is this idea of an exit tax. Now, whether you agree with these policies or not is totally beside the point. For our analysis, what matters is that the mere threat of these taxes forces big money, institutions, wealthy families to rethink how and where they store their wealth.
This quote just sums up the appeal perfectly. Think about it. Traditional assets like stocks, bonds, real estate, they're all held in centralized systems. That makes them easy to find, easy to count, and easy to tax, or even seize. Bitcoin, on the other hand, is decentralized. It's borderless. It is a digital vault where you hold the keys, and it exists outside the direct control of any one government or bank. And that property is making it incredibly attractive as a hedge against exactly this kind of political risk.
Okay, so now it's time to put it all together. We've laid out three really powerful, independent forces. Let's see if we can combine them into one single idea that explains what's really going on in the market. So first up, we have this new reality of structural, persistent inflation, and it's being driven by the massive, non-stop energy needs of the AI revolution. Then, this sticky inflation is pushing us straight towards a negative real rate world, a world where just holding cash and bonds is a guaranteed way to lose your purchasing power. And third, you layer on top of all of that a political climate that is making wealthy people and institutions more and more nervous about the safety of their traditional, easy-to-grab assets.
And when you put those three powerful forces together, well, you get the perfect storm for an asset like Bitcoin. It's not just a speculative tech play anymore. In the minds of some of the world's smartest investors, it is being completely repositioned as a legitimate institutional safe haven asset, kind of like a true digital gold for the 21st century.
And look, this isn't just some theory we're cooking up. We can see the proof in where the money is going. The launch of the spot Bitcoin ETFs, that basically opened the floodgates for institutional money. We're seeing more and more big companies putting Bitcoin on their balance sheets. And maybe the biggest tell of all, the giants of traditional finance, we're talking Citi, Goldman Sachs, Morgan Stanley, they are now offering custody services. This isn't just retail FOMO. This is the smart institutional money making a very calculated move into digital scarcity.
So the big question is, what does all of this mean for you and for your portfolio? Let's get practical. It's so important to be aware of the risks here, but also to understand the potential reward. The cons are pretty well known, right? Bitcoin is volatile. It can have some wild price swings. And yeah, regulatory uncertainty is still a key risk. But the pros, especially in the world we just described, are pretty compelling. It offers what's called asymmetric upside, it's a powerful inflation hedge, and it acts as a non-seizable asset, a quality that seems to be getting more valuable every single day.
So how does a smart, long-term investor even think about this? Well, probably not by going all in, but maybe by considering a small strategic allocation. Think of it like a form of portfolio insurance. A 1 to 5% position could act as a powerful, asymmetric hedge against all the risks facing the other 95% of your portfolio. If this whole macro story plays out, that tiny slice could have a huge positive impact, while your potential loss is capped at just that small amount. Which leaves us with this final, really provocative question. We've gone through the argument. It's scarce, it's durable, it's portable, and now it's being accepted by major institutions. So given the macroeconomic storm that we seem to be sailing into, is Bitcoin finally ready to claim that title of digital gold? Is it becoming the premier safe haven asset for our century?
I'd love to know what you think. Is this big macro story on your radar? Drop a comment below and let us know.
If you found this breakdown valuable, please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. Thanks for tuning in.